Initially, saving money can seem like the most viable option when it comes to building wealth, but there are far more better choices when it comes to growing your finances. The goal is to passively make as much money as possible, so we can live the lives we dream of. Hello and welcome to our channel. Today we are going to discuss the differences between saving and investing. Saving money means storing away your money so that it is available when you need it. Although it has a low risk of losing value, it also has zero returns on investments. Investing comes with risk, but also has great potential for higher returns. Both saving and investing are key pieces to one's personal finances. Is saving a good idea? Saving money for both purchases and emergencies are an essential part of personal finances. It involves setting aside money for future use, but saving money typically only meets short-term goals, such as car repairs, medical bills, or going on vacation. Savings are generally low risk, meaning your money is safe, but the interest rates received are little to none. Generally speaking, short-term for savings are considered to be around 1 year or less, so you would have to keep in mind your plans for the funds and the safety or risk associated with the goal. Saving may keep you afloat in the short term, but there are many drawbacks to consider. Saving will cause you to miss out on potentially higher returns from riskier investments. Saving can also lose purchasing power caused by periods of rising inflation. Here are the pros and cons of saving. It builds up an emergency fund. It funds short-term goals like buying groceries, a new phone, or vacation. Minimal risk or loss. Savings are held at banks that, protected by the FDIC, much lower yields, may lose out to inflation. Opportunity costs when not invested in riskier but high-yielding assets. In conclusion, your savings account contains funds that are not growing constantly or making you any profit. What is investing? Investing is a great way to grow your money over time by depositing funds into financial instruments such as stocks, bonds, and mutual funds. Unlike saving, investing comes with great risk, but it also has great potential to earn high returns over the long term. Investing is a great way to reach long-term financial goals, such as college, down payment on a house, or retirement. But you should know investing involves taking on a risk, so it is essential to choose investments wisely, the investments that align with your goals, risk tolerance, and time horizon. You have to ride out the ups and downs of the stock market. The longer you invest, the more risk you take on. An important thing to remember is that investing comes with zero guarantees. There is always a risk of losing money, but that should not stop you from trying. We all are going to lose money at some point in life, so why not give yourself a fighting chance to earn big? For instance, let's say you invest in companies like Nike or Adidas. By buying shares of its stock, you own a fraction of the company and can benefit from its growth and profits. If they perform well, the value of its stock could increase over time, allowing you to sell it for more than you invested. Here are the pros and cons of investing. Potential for higher returns than savings can help achieve long-term financial goals. Diversification can reduce risk. Risk of loss, especially in the short run, requires discipline and commitment, may require longer time horizons. Diversification can reduce your risk of losing a lot of money because it is deposited across several holdings. It's important to do your research and understand the potential risks with different types of investments. It requires discipline and long-term mindset, which can be difficult this day and age. When to save and when to invest. This depends on your particular financial situation, goals, and risk tolerance. When you are young, you have time on your side and limited expenses. It's never too early to start saving or investing. As a young person, you can take more risk and invest in riskier assets. Even if you suffer losses in the short term, you have more flexibility to recover. You can also benefit from the positive effects of long-term investing. As you get older and have a shorter time horizon, it is recommended that you should shift out of riskier assets such as stocks and into more secure ones like bonds and cash. This is because it is more of a potential risk if the market crashes just as you're about to retire. Although saving is not too bad if you only have short-term goals and need access to your money in the near future and can't afford to lose any of it, the long-term should always be the plan when it comes to your future. Why do some people fail at investing? There are several reasons why people fail. Most common is lack of experience or knowledge, which can lead to poor investment decisions. Another can be fear or greed, which can cause investors to make impulsive or irrational decisions that may result in losses. If you want to be successful in investing, it requires a long-term perspective, discipline, and patience. The bottom line is that saving and investing are both important parts of a healthy financial plan. Saving provides a way to achieve short-term goals, while investing has the potential for higher earnings and can help achieve larger goals. Each approach has its pros and its cons. It's up to you on which route to take. Find the balance that works for your financial situation and goals. Our goal is to help people provide a solid foundation for a more secure financial future. Let's help one another break out of this rat race, one video at a time. We appreciate you tuning in and hope to see you again soon. Hope you enjoyed this video. Feel free to click on one of our other videos, and do not forget to subscribe to our channel and do hit the bell icon on your way out. See you all next time on Top 5 Hive.